Hello, my name is Manny Kagan. I'm a mortgage master, founder of Mortgage Solutions Academy, and a very special guest, Sheldon Smith. Sheldon works for a company called PacRes. It's one of the mortgage banks who offer very interesting programs specifically for the first-time home buyers, or maybe not first-time buyers, but those who are in today's market have difficulty to qualify conventional loans. Those loans are called buy-downs. And I asked Sheldon to come specifically to share with you what is it? What's a buy downs?
Right on. Manny, always a pleasure. Always a pleasure. And as you and I were talking about, as we talk frequently in regards to mortgages and what has happened in today's market, it's mostly a purchase market, as refis are far and few between. And we're trying to find creative and innovative options to help you and your clients to get into mortgages. Because as you know, interest rates will be higher. So one of the unique products that we offer is called a buy down product. And there's two differences. You have a permanent buy down and you also have a temporary buy down. So this product in particular is a temporary buy down product where you have the option of offering the client a lower interest rate for 1, 2, or 3 years.
Interesting. I remember those loans from early days when those loans were offered to the builders, were through the builders actually, where builders were paying those buy downs.
Exactly.
Who is paying now?
So right now it's still so it's either the seller, a third party, or an agent. So the buyer themselves cannot pay the points to buy down the interest rate. So it has to be a third party. And the great news about it, when you're in a purchase market, sellers are more open to negotiate and give concessions. And based on that fact, you're able to negotiate and says you like to buy down the rate, and the seller offer a concession to do that buy down. So the buyer cannot pay the points.
Yes.
It has to be a third party.
Okay. The points means that the percentage from the balance on a mortgage, which allows you to lower monthly payments and interest rate.
Well, not necessarily. This buy down is different. It's not like the permanent buy down is where you finance the points into the loan. The temporary buy down is actually where third party contribute the points towards the buy down. It is put into an escrow account to supplement the mortgage payment that if you opted for. So say in the case the current interest rate is 7.25. If you did a 3-1 buy down, it means the first year the interest rate is going to be lower than 3%. So what's going to happen?
Lower than 3%? What
yes,
do you mean?
Lowered by 3%.
By 3%.
Yeah. So 7.25, a 3-1 buy down mean the first year the interest rate would be
4.25.
4.25. The next year 5.25, and then the third year it will be 6.25, and 4 through the remaining 30 it will be back to the 7.25.
So interest rate is a little bit higher because of the buy down. So let's say it's if interest rate is for 30-year fixed is 7%, this one will have 7.25.
No, I was just giving an example.
I see.
I was just gonna
because this is what I remember, that those loans had a little bit higher rate, but they gave it buy down. Now, in terms of qualifying, are the borrowers qualified at lower rate at 4.25?
You would qualify the current market rate.
Oh,
so
I see.
It doesn't. So the temporary buy down, it doesn't really impact how you qualify. It's a payment driven. So as you know, a lot of borrowers are trying to get into homes now. They can qualify, but they're concerned about higher
cash flow.
So this gives you an opportunity to say to the borrower, okay, if you qualify, it's a great opportunity to buy. Here's an option for you to get in and make lower payments. And based on the dynamics of the market, there's a possibility this bar could be refined within 6 to 9 months if the market were to change.
I see. Okay. So basically, the rate's 7.25 in this example.
Yes.
But payments are first year 4.25, then 5.25, 6. So this is a huge advantage for people who are concerned about cash flow.
Yes, and so far, a lot of the business that I'm doing are, as you know, purchases, and it usually get a lot more borrowers and realtors excited because I'm like, okay, there's a possibility that my borrower could make lower payment for 2 to 3 years, and it totally makes sense. And you find less challenges in today's market for a seller to want to contribute towards that because it's a seller's driven market.
Okay, so let's say since we're talking about conforming limits,
yes,
can it be an agency jumbo? In other words, higher, or it's still
It's
on a lower end,
it's still on the lower end.
which is 700. New conforming limit is going to be what? Do you remember?
715, give or take.
Yeah, so
in the
it's
vicinity.
not defined finally, but
Yeah.
estimate is 715.
Yeah,
So in this case, and what has to be loan to value?
you could be as high as 97%.
So 97%. So this is not FHA loan. It says this is just a Fannie Mae loan.
Well, here's the advantage. You could do this on FHA, conventional, or VA. So the buy down works across the board. So if you have,
Interesting.
yeah, so in a case on a VA transaction, you could do 100% financing on a VA.
As long as the seller will pay for those
As long as the
differences.
seller, or if an agent want to contribute.
Yes.
So a third party could contribute towards a buy down. It's just the buyer themselves cannot.
You mean agent is real estate agent?
Yes.
Can we do it?
No, you as a broker cannot.
I see. Okay, so now it's a real estate agent, some third party parents.
Not any affiliation. It would have to be the real estate agent, the builder, or the seller.
I see. Okay. All right. Seller is okay.
Yeah.
Now if its property was sitting in the market for a while.
Yeah.
I was using this in one of my presentations.
Yeah.
This concept. Okay. Now I didn't know those particular details.
Yeah.
And it's called temporary buy down.
It's called temporary buy down because we don't want to confuse a permanent with a temp buy down. The permanent buy down is where you finance the points in the loan amount. And in some cases, it doesn't really make sense because the borrower is paying higher interest rate on a bigger loan amount. So in this case, this is called a temporary buy down because it's only temporary for either a year, 2 or 3 years.
As long as we are in the realm of conforming limits, whatever new conforming loan amounts are going to be, this is how it's, so 715 or whatever number is going to be, this is how we can be using it.
Yes, and I think we have to use this as an opportunity to educate our realtor partners.
Yes.
Because we're all looking for innovative options of how we get our borrowers into properties. Because a lot of people are on the fence.
Yeah.
When you quote someone and say the interest rates are 7%, a lot of people get intimidated by that number. Yes. But if we get to the point now where we could educate realtors and brokers and everyone and said, listen, we know the market is tough, but it's a great opportunity for people that weren't able to buy last year to get into contract now. Because as we know, the market is not going to be stagnant forever. So if you have an opportunity to get into the market now with an advantage as a buy down product, then you are actually ahead of the game for when the market turns. Because when the market turns again, you know it's going to be a bomb rush. Everyone trying to get back.
Perfect. Perfect. I want to stop here because it's a lot of information. And it's a lot of new information, even for me. Yeah. Thank you, Sheldon. It was very informative. So until the next time, I'm Manny Kagan. I'm the Mortgage Master.
Thank you.
I promise to help you. Thank you.